You know the drill. You're scrolling through real estate listings at midnight, and every single house that doesn't look like it's about to collapse costs $500,000. In many markets, $500,000 buys a 1,200 square foot box with 3 bedrooms, 2 bathrooms, a yard the size of a beach towel, and laminate countertops straight out of 2003. You sit there doing mental math on your salary, wondering if you somehow missed a massive promotion, or if the entire housing market has collectively lost its mind. But everyone keeps telling you it's doable. The mortgage broker says you're approved, your parents bought a house on way less, some influencer on TikTok claims they're flipping houses with no money down. The math behind these listings is becoming harder and harder to justify. The numbers suggest the entry-level home has effectively transitioned into a luxury asset. There is a massive difference between a bank qualifying you for a mortgage and you actually being able to afford a life after you sign the paperwork. We're going to calculate who can legitimately afford a $500,000 house without turning their world into a financial stress simulator. Let's look at this data visualization mapping out down payments. The old rule of thumb was 20% down. On a $500,000 house, that's $100,000 in cash. Compare that to the tiny bar at the bottom. The median savings account in America has around $8,000 in it. You are $92,000 short. So you skip the 20% and put down 5% or 10% instead. That introduces an expense called private mortgage insurance, or PMI. It's a monthly penalty fee required because the bank considers the loan high risk, and the policy protects them, not you. This chart breaks down the monthly costs. If you put down 10% on that $500,000 house, you're left with a $450,000 loan. At current interest rates, your base principal and interest payment lands right around $2,850 a month. But that doesn't cover a single other thing you need to actually keep the house. Let's stack on property taxes. Depending on where you live, that conservatively adds another $500 per month. Then there is homeowner's insurance, which has risen lately as climate risks make properties more expensive to insure. Add another $300 to the stack. Next, budget 1% of your home's value annually for maintenance. That's $417 a month for when the water heater explodes. Finally, cap it off with $300 for that PMI we talked about. Your total monthly housing cost is now sitting at $4,367. That is roughly $1,500 in hidden, non-negotiable costs layered directly on top of your base mortgage quote. This gap between the initial quote and the actual check you write is exactly where financial instability begins. Financial advisors typically recommend spending no more than 28% of your gross monthly income on housing. If we reverse engineer that $4,367 monthly payment, you need to be making roughly $187,000 a year to comfortably carry this house. This chart illustrates U.S. household incomes. The median household income in America sits at around $84,000. Look at the far right tail of the curve. Only about 10 to 20% of U.S. households make over $150,000. Let's look at a real-world example. Meet the Johnsons, an upper-middle-class household earning $160,000 a year. They earn well above the median and should be perfectly comfortable. Their gross income of $160,000 sounds impressive until the IRS shows up. After federal taxes, state taxes, FICA, and a modest retirement contribution, their actual take-home pay shrinks to around $9,500 a month. Subtract that $4,367 housing cost, and they're left with about $5,100. Subtract $800 for 2 car payments, $250 for car insurance, $300 for gas, $600 for student loans, $400 for health premiums, and $800 for groceries. They're down to about $1,500 for utilities, clothing, emergencies, and actually having a life. Since 1990, home prices have increased roughly 400%. Over that exact same period, median household income grew by about 180%. Because housing costs outpaced wages by such a massive margin, the housing market has effectively disconnected from income reality. Households spending nearly half their take-home pay on a mortgage are completely exposed. One broken HVAC system or one medical bill is all it takes to collapse their entire budget. Nobody in this transaction has an incentive to tell you that you're about to financially drown. Banks approve high debt-to-income loans, and real estate agents push you to stretch your budget because they profit when the deal closes. Because housing has become so expensive, the places like Denver, Austin, or anything within commuting distance of a major metro. This $500,000 price tag is what people are expected to produce for normal houses. Once you sign those papers, you are trapped. You can't just decide 6 months later that buying was a mistake and walk away without destroying your credit and losing your down payment. The system rewards the purchase of the asset. It completely ignores whether you can comfortably survive the mortgage over the next 3 decades. The common argument is that renting is throwing money away. Yet paying interest, maintenance, and taxes on an unaffordable mortgage carries its own heavy financial toll. Real wealth is having margin in your monthly budget. It's the freedom to invest consistently instead of dumping every spare dollar into an asset you're trapped in. You can choose not to play this game. You can keep renting and save aggressively. You can wait for prices to correct, or you can relocate to a cheaper market where the math actually aligns with your income. Real security is handling a surprise car repair without panic. It's sleeping at night without anxiety over how you'll cover next month's property tax bill. Ernest, stop looking at what the bank says you qualify for. Start looking at the number where you can pay the mortgage, handle the maintenance, and still remember what it feels like to not be stressed about money. There is no prize for buying a house you can't afford. There is no trophy for being house poor. The real win is making decisions based on honest math and protecting your financial freedom. You're scrolling through real estate listings at midnight, and every single house that doesn't look like it's about to collapse cost $500,000. The kitchen has laminate countertops from 2003. There's fake wood paneling in the basement, and the listing agent still has the audacity to call it a starter home. Meanwhile, you're sitting there doing mental math on your salary, wondering if you somehow missed a massive promotion or if the entire housing market has collectively lost its mind. But the pressure keeps coming. The mortgage broker says you're approved. Your parents bought a house on way less income, and some influencer on TikTok is flipping houses with no money down, telling you to just jump in and make it work. That feeling of financial failure isn't a personal flaw. It is the direct result of an economic formula that has completely broken. Today, we are going to calculate exactly who can actually afford a $500,000 house without turning their life into a financial stress simulator. We aren't looking at who the bank will give a loan to. There is a massive gap between qualifying for a mortgage on paper and actually being able to sleep at night after you sign the paperwork. The standard industry definition of affordable is a deceptive metric that is actively lying to the vast majority of Americans. Let's start with the down payment, because that's where most people's dreams hit a wall. The traditional 20% rule requires $100,000 in raw cash for a baseline $500,000 home. The median American savings account holds about $8,000. That leaves the average person $92,000 short. Even if you manage to save 10% of a median income every single year, which almost nobody does, it would take 12 years to close that gap. Most people bypass this barrier by putting down 5% or 10% instead. However, this triggers a secondary monthly expense, private mortgage insurance, or PMI. This runs anywhere from $200 to $400 a month. It is a structural poverty tax. You're paying extra money every month for insurance that protects the bank, not you, simply as a penalty for not having a massive lump sum of cash. Let's look at the monthly ledger. With 10% down, your principal and interest payment on a $450,000 loan lands around $2,850. Now add property taxes. A conservative estimate adds roughly $500 to that stack every month. Then there's homeowner's insurance. Climate change makes houses significantly more expensive to insure, causing premiums to skyrocket nationwide. You're looking at another $300 a month. You also need to budget for unseen maintenance. The standard 1% rule means setting aside $5,000 a year for repairs, converting to a hidden monthly expense of $417. Finally, tack on the $300 PMI penalty. Your true monthly housing cost has now ballooned to $4,367. This figure assumes nothing goes wrong. It doesn't account for a new roof, a broken HVAC, or a random $3,000 HOA assessment. You are entering homeownership completely exposed to financial shock. Financial guidelines suggest you shouldn't spend more than 28% of your gross monthly income on housing. When we reverse engineer that $4,300 monthly cost, the numbers are jarring. To stay within that 28% safety zone, your household needs to earn roughly $187,000 a year. Only about 10 to 20% of U.S. households actually pull in that kind of income. Even an upper middle-class couple making $160,000 a year will find themselves with almost zero margin. Once you subtract taxes, two car payments, health insurance, and student loans, they are left with just $1,500 for literally everything else in their lives. For a median income earner, pursuing this house creates a level of risk that would make a skydiver nervous. It is mathematically impossible without accepting a catastrophic level of daily financial precariousness. The housing market doesn't care about these numbers. Real estate agents, banks, and insurance companies profit when you buy, not when you make a smart decision. The system is designed to get you into the house, not to ensure you can survive it. We keep judging our success against previous generations, back when a house cost only 3 times a family's annual income. Since 1990, housing prices have surged roughly 400%. They forget to mention that being house poor is also throwing money away on interest, taxes, and repairs, just with higher stakes and more stress. Real wealth is freedom, not trapped equity. It is having liquid margin in a budget to invest consistently without having to choose between fixing your roof and contributing to your retirement account. You have permission to run your own numbers and walk away from an inflated property. There is no trophy for buying a house that makes you miserable. The ultimate key to mental peace is making decisions based on mathematical reality rather than societal pressure. Don't let a rigged market dictate your financial future.